I'm Danny Clayton, joined in the studio by Dr. Brian Jacobsen, Chief Economist at Annex Wealth Management. Welcome to the show.
It's great to be here.
Let's go back to last weekend. The situation in Israel and the Gaza Strip, utterly horrible, big impact. I thought, just assuming that the markets get nervous, that Monday we were going to see a real decline, and we did not. Why was that?
You know, I think that's interesting. When you look at the history of conflict, it really depends on the details. I think that one of the key things is that after Hamas attacked Israel, that the big question was, how long will it last? And will other countries get drawn in as well? One of the big unknowns was as far as Iran's role. And just historically, if Iran gets involved in something, they threaten to close the Straits of Hormuz, which is a major choke point for the shipment of oil. And so one of the spillovers to the rest of the world and to the markets is oftentimes through the oil price. Now, obviously, there's the fear factor at work as well. And we did see within the markets kind of this knee-jerk response that seemed justified. People started buying more U.S. government bonds, this flight to safety. The dollar strengthened, gold went up, oil prices increased a little bit, and like defense stocks. So people that maybe provide munitions and things like that, their stocks did well. The broader market seemed to shake it off, mainly because the big question is, I oftentimes look at it and I'm like, what does this mean to the bottom line of Apple? Right? Does this conflict, will it affect corporate profitability? And that's one lens that you can use to kind of look at, why did the market do what it did? And I think the big reason is that right now it seems like it is relatively contained, and we do have to see how long it'll last.
We still don't really know if other nations will get involved. I mean, depends on what Iran will do. More shoes could drop.
Yes, that is correct. And so it increases the risks. I think about things in terms of kind of what's a base case scenario, what's a bear case scenario, and what's a bull case scenario, kind of thinking about it through those three avenues. And the bear case gets a little bit worse as far as now that you have conflict, if it does spread. But the base case, I don't think we've really deviated from that base case scenario yet, which is one of, we had an earnings recession over the last 3 quarters. U.S. economy had a great third quarter in terms of growth, showing some signs of fatigue. And so a lot of we haven't seen enough yet to move us off of that base case scenario.
Speaking of fatigue, anybody tired of hearing about the CPI, Consumer Price Index? That number came in. We've been watching this for a couple of years now as it's ticked up, and it came in a little hotter than expected.
It did, and it reminds me of when Alan Greenspan talked about setting an inflation target. He said he wanted inflation to be low enough that people didn't really think about it. And so nobody really cared about CPI. Now it's in headlines all over the place. It came in a little bit hotter than what people were expecting. But when I dig into some of the details, most of the increase was driven by energy prices. And we all know that energy prices have gone up. And then also this fictitious thing that the government measures called owner's equivalence rent. It's this hypothetical about, if you own your home, how much would you charge yourself to live there? And they try to kind of figure that out from rental rates and things like that they can actually observe. But it really, those were the biggest drivers. And so even though the headline was very hot, I thought that the details were not.
The other PI would be the PPI, the Producer Price Index, basically what it costs to produce goods for sale. Is that right?
That's correct. Yeah. So the Producer Price Index, as measured from suppliers, that came in a little hot as well. Year on year, it was only up 2.2%. So a lot of progress has been made there. So hopefully there's not a lot of inflation in the pipeline coming.
But if it costs more to produce something, prices are raised?
It can. Another thing that can happen is profit margins are crimped. And that's the big variable here is, do they pass through that inflation to the final consumer? Or is it the case that the producer prices go up without consumer prices going up, meaning you've got a little bit of headwind as we're going into earnings season here?
And at this point, our heads swivel toward the Fed. What do you think?
Yeah, I think that they're on hold. They've been talking about how this increase in yields that we've seen, that you're actually the market is doing a lot of work for the Fed. They might not need to hike rates. We got the minutes from the last meeting. It said most of the debate was around how long they should hold rates where they are, as opposed to whether or not they should do one more.